Every single year, the wealthiest Americans and corporations legally move $495 billion away from the IRS. Not illegally, not secretly, legally, openly, using the exact same tax code you have access to. Apple paid almost nothing on $111 billion in offshore profits. Amazon built a $1 trillion empire while paying an effective tax rate lower than a schoolteacher. And billionaires like Elon Musk, Jeff Bezos, they borrow against assets instead of selling, meaning they generate billions in cash flow and owe almost nothing in income tax. Meanwhile, you're handing 22%, 24%, even 37% of your paycheck straight to the government. Here's the brutal truth. The tax code isn't broken. It's working exactly as designed, just not for you. Not yet. In the next 16 minutes, I'm going to walk you through every major legal tax reduction strategy that exists in the U.S. tax code right now. The same tools the ultra-wealthy use. These aren't loopholes. These are features, written into the law, available to anyone willing to use them. Let's destroy your tax bill legally. Before we get into the strategies, I need to destroy one myth that costs the average American tens of thousands of dollars over their lifetime. The myth is this: paying less tax is somehow wrong. No, it's not. Tax evasion is illegal. Hiding income, lying on returns, not reporting earnings. That's a crime. The IRS convicted 89% of the cases it took to court in 2025. Don't do that. Tax avoidance is legal. Using every deduction, account, credit, and structure that Congress specifically created and embedded into the law. That's not cheating. That's reading the instructions. The government uses the tax code as a behavior modification tool. It says, we want Americans to save for retirement, so we'll reward you with a tax break. We want Americans to invest in real estate, so we'll give you a massive deduction. We want people to stay healthy, so we'll give you a triple tax advantage on medical savings. Every strategy I'm about to show you is the government literally asking you to pay less tax in exchange for doing something they want you to do. The question is, are you going to take the deal? Let's start with the single most powerful tax reduction tool available to every working American, and the one most people are massively underusing, the 401k. In 2025, you can contribute up to $23,500 to your 401k. If you're 50 or older, that jumps to $31,000 with a catch-up contribution. Here's what that actually means in dollars. If you're in the 24% tax bracket and you max out your 401k, you just reduce your tax bill by $5,640 in a single year. One move, legal, immediate. But most Americans don't max it out. The average 401k contribution in the US is around $7,000 a year. People are leaving $16,500 in annual tax deductions on the table every single year. Now let's go deeper. The Backdoor Roth IRA. If you make over $146,000 as a single filer or $230,000 married filing jointly, you can't contribute directly to a Roth IRA. But here's what the tax code quietly allows. You can contribute to a traditional IRA and then convert it to a Roth. This is the Backdoor Roth, and it's completely legal. It gives you tax-free growth and tax-free withdrawals in retirement. No income tax, ever, on that money. And if your employer allows it, and more do every year, there's the Mega Backdoor Roth. The total 401k contribution limit, including employer and after-tax contributions, goes up to $69,000. You contribute after-tax dollars, roll them into a Roth, and now you have a massive tax-free account that compounds untouched for decades. This is generational wealth building, legally shielded from the IRS. The HSA, the Stealth Retirement Account. If you have a high-deductible health plan, you have access to what many tax professionals call the greatest tax vehicle in the entire U.S. tax code. The Health Savings Account is the only triple tax-advantaged account that exists. Contributions are tax-deductible growth, is tax-free withdrawals from medical expenses are tax-free. In 2026, you can contribute $4,400 for individual coverage, $8,750 for a family. Here's the move that almost nobody talks about. Don't spend the HSA. Pay your medical bills out of pocket now. Save your receipts. Let the HSA grow invested in the stock market for 20 years. Then, legally, reimburse yourself tax-free for every medical expense you ever had. There's no time limit on reimbursements. After age 65, you can withdraw for any reason. It just gets taxed like a traditional IRA, meaning your HSA is literally a second retirement account with no downside. If retirement accounts are the foundation, real estate is the wrecking ball. Real estate investors in the U.S. benefit from one of the most favorable sections of the tax code ever written. Let me break down the major ones. Depreciation. When you own investment property, the IRS allows you to deduct the cost of the building over time, even if the property is actually appreciating in value. Residential property depreciates over 27.5 years. Commercial over 39 years. This means you can collect rent checks, positive cash flow, and simultaneously show a paper loss on your taxes. You're making money in the real world. You're showing a loss on paper. That paper loss offsets your taxable income. This is not a trick. This is written directly into the tax code. It's why so many wealthy Americans own rental properties. Cost segregation. This is depreciation on steroids. A cost segregation study breaks a property down into components: flooring, appliances, landscaping, HVAC, and accelerates depreciation on those parts. Instead of depreciating over 27 years, certain components depreciate in 5, 7, or 15 years. This creates enormous upfront deductions in the first years of ownership. A $500,000 rental property could generate $80,000 to $100,000 in year one deductions through cost segregation. That's cash flow in your pocket while the tax code credits you with a loss. The real estate professional status. Here's where it gets powerful. By default, rental losses are passive. They can only offset other passive income. But if you or your spouse qualifies as a real estate professional, meaning more than 750 hours per year of real estate activity, and it's your primary occupation, those losses become active. They can offset your W-2 income, your salary, your investment income, everything. A surgeon making $400,000 a year whose spouse qualifies as a real estate professional and owns rental properties with $150,000 in depreciation deductions could reduce their taxable income by $150,000 in a single year, legally. Short-term rentals. Airbnb and VRBO properties have a specific carve-out in the tax code. If the average stay at your rental is 7 days or less, it's classified as a short-term rental, not a passive activity. The losses can often offset active income without needing real estate professional status. This is one of the fastest growing legal tax strategies in America right now. Let me tell you the single biggest financial mistake most Americans make: staying an employee. Not because employment is wrong, but because the entire U.S. tax code is structured to reward business owners more than employees. When you're an employee, you get paid, and then you pay taxes on what's left. When you own a business, you pay for everything the business needs, and then you pay taxes on what's left. The order of operations is completely different, and it changes everything. The Section 199A QBI deduction. If you operate as a pass-through entity, sole proprietorship, S-Corp, partnership, you may qualify for the qualified business income deduction. Up to 20% of your qualified business income is completely deductible. A freelancer making $200,000 through an S-Corp could deduct $40,000 right off the top. Self-employed retirement plans. If you have any business income at all, side hustle, consulting, freelance, you can open a solo 401k or SEP IRA. A SEP IRA allows contributions up to 25% of net earnings, capped at $70,000 in 2025. A solo 401k allows both employee and employer contributions, potentially letting you shelter far more income than a traditional 401k. Business expenses, home office deduction, business vehicle, education and professional development, health insurance premiums, travel to conferences, business meals, software, equipment, Everything that legitimately supports your business is a deduction. The wealthy don't pay their personal expenses with after-tax dollars. They run legitimate businesses and deduct the business portion of everything. You can too. Entity structure. An S-corporation can split your income into salary and distributions. You pay payroll taxes only on the salary portion. If structured correctly, this can save a self-employed person $10,000 to $30,000 a year in self-employment taxes alone. Not income tax. Self-employment tax, the 15.3% that employees split with their employers. Business owners pay both sides, but S-Corp owners can dramatically reduce it. Now let's talk about the big leagues. These are the strategies that generate the $495 billion annual figure I mentioned at the top. Tax loss harvesting. The stock market goes up and down. When an investment is down, you can sell it, realize the loss, and use that loss to offset capital gains elsewhere in your portfolio. Then you buy back a similar, but not identical, investment within 30 days. The IRS calls it a wash sale if you buy the same security, so you buy something similar. The result, you reduce your taxable income while maintaining essentially the same market position. Major wealth management firms do this automatically year-round at scale. It's completely legal and potentially saves high earners thousands every year. Donor-advised funds. Instead of writing a check to charity, you donate appreciated assets, stocks, real estate to a donor-advised fund. You get an immediate tax deduction for the full market value. You avoid capital gains on the appreciation, and you can distribute the money from the fund to your chosen charities over years or decades. This is how billionaires donate to charity in a way that also dramatically reduces their current year tax bill. You don't need to be a billionaire to use this structure. Municipal bonds. The interest on state and local government bonds is exempt from federal income tax. For high earners in the top brackets, a municipal bond yielding 4% can be equivalent to a taxable bond yielding 6.5% or more. Tax equivalent yield is the game, and it's entirely legal. Opportunity zones. Invest capital gains into a qualified opportunity fund in a designated low-income area, and you can defer those capital gains taxes and potentially eliminate them on the appreciation of the new investment after 10 years. This is a direct incentive Congress wrote into the tax code in 2017 to stimulate investment in underserved communities, and it comes with massive tax benefits for investors. The borrow-don't-sell strategy. This is the secret the ultra-wealthy use to live lavishly while reporting almost no taxable income. Instead of selling appreciated assets and triggering capital gains tax, they borrow against those assets at 1 to 3% interest rates. Loans are not taxable income. They live off the loan proceeds, pay manageable interest, and when they die, their heirs receive a stepped-up basis, meaning the capital gains disappear entirely. This isn't available to most Americans at scale. But understanding it reveals something important. The tax code rewards unrealized gains. That means the longer you can hold assets and defer realization, the lower your lifetime tax burden. Here's the global context that most personal finance channels won't give you. The U.S. is not alone in this battle. Governments worldwide are watching $495 billion, just from U.S. multinationals alone, flow through tax havens like Ireland, the Cayman Islands, Luxembourg, and Bermuda every year. The OECD's global minimum corporate tax of 15% is an attempt to stop this, but it's a corporate story. For individuals, the playbook is different and more durable because the strategies I've outlined today are domestic. They don't require offshore accounts. They don't require lawyers in the Cayman Islands. They're built into the American tax code for American taxpayers. Meanwhile, here's what's coming. Tax rates are historically low right now. The Tax Cuts and Jobs Act provisions that created the current brackets are scheduled to expire. Without congressional action, rates revert in 2026. The window to execute Roth conversions, lock in low capital gains rates, and maximize current deductions is now. Not next year. Now. Smart tax planning isn't just about reducing this year's bill. It's about positioning yourself across a 10, 20, 30-year horizon where tax rates may look very different. Let me give you a clear, actionable roadmap based on where you are. If you're employed, max your 401k, $23,500 in 2025, non-negotiable. Open an HSA if you're eligible. Max it. Invest it. Don't touch it. Execute a backdoor Roth IRA if your income exceeds the direct contribution limits. Consider starting a side business, even small, to unlock business deductions. If you're a business owner or self-employed, evaluate your entity structure immediately. S-Corp versus LLC versus sole prop can mean 5 figures in savings annually. Max a solo 401k or SEP IRA before your tax deadline. Review every legitimate business expense you're currently paying personally. Talk to a CPA who specializes in tax strategy, not just compliance. If you're a high earner, $200,000 plus. Cost segregation plus real estate is worth serious exploration. Donor-advised funds before year-end for any appreciated assets. Tax loss harvesting should be happening automatically in your investment portfolio. Roth conversions during any lower income year are a generational opportunity. The single most important thing I can tell you, the IRS is not your enemy. The tax code is not your enemy. The only enemy here is inaction and ignorance. The gap between what the wealthiest Americans pay and what the average American pays isn't primarily about illegal evasion. It's about strategy. It's about using a system that was built with these tools embedded and having the knowledge to use them. You now have that knowledge. Find a qualified CPA or tax strategist. Not a tax preparer, a tax strategist. Someone who plans proactively, not reactively. Someone who looks at your entire financial picture 12 months before April 15th, not after. The ultra-wealthy didn't get wealthy by paying more than they owed. They got wealthy, in part, by understanding the exact rules of the game you're playing. Now you do too. If this video opened your eyes, share it with someone who's overpaying. Subscribe for more strategies the financial establishment doesn't put on the front page. And drop a comment. Which of these strategies are you implementing first? I'll see you in the next one.